If you want to understand why silver sells off right after a CME margin hike, you have to start with a basic truth that most retail commentary ignores. The futures market isn't a price discovery machine in the way people imagine it. It's a risk-managed leverage venue. The exchange's primary goal is not to help bulls or bears. It's to make sure every contract can be honored even during extreme volatility. Margin is often misunderstood. It is not a commission or a penalty. It's collateral, a performance bond. When you buy or sell a futures contract, you control a large notional position with a relatively small amount of capital. That's leverage. Leverage magnifies gains, but it also magnifies losses. If price moves against you, your account equity drops quickly. And because the exchange guarantees settlement through its clearinghouse, it cares deeply about how likely it is that traders can cover losses in real time. That's where margin hikes come in. When volatility increases, the probability of large intraday moves rises. Large intraday moves increase the chance that a trader's account goes negative before they can meet a margin call. If enough accounts blow up at the wrong time, the clearinghouse absorbs the shock. Exchanges are built to prevent that scenario. So when volatility rises, they raise margin requirements to reduce leverage across the system. Now, here's the key. Silver is especially sensitive to this, because silver is typically more volatile than gold. The market is thinner, and the positioning can become crowded quickly. Silver also attracts speculative momentum flows traders who love leverage because it offers huge percentage moves. When silver starts rallying hard, leveraged longs pile in. So open interest can climb. Option activity can intensify. Volatility can jump. The system becomes fragile. So the CME raises margins. What happens next is mechanical, not emotional. Every trader holding futures now has to post additional collateral. They have a very short time window to meet that requirement. Some traders can add cash. Many can't. They don't want to. So they reduce exposure by selling contracts. This selling pressure hits the market quickly, often at the exact moment when sentiment already feels stretched due to the prior rally. That's why margin hikes often trigger some. But the margin hike isn't the true cause. It's the pin that hits the balloon of accumulated leverage. Think of it like this. A margin hike forces the market to reprice leverage, not silver. The exchange is saying, this instrument is moving too violently for the current collateral levels. The market responds by deleveraging. Deleveraging means selling pressure, especially from leveraged longs, because they are the ones most exposed after a run-up. And once that selling starts, it creates secondary effects. Margin call cascade. Initial sell-offs reduce price. That price drop reduces equity for other leveraged longs. They get margin called too. They sell. The cycle repeats. Stop-loss chain reaction. Many traders set stops below obvious support levels. A fast drop hits those stops. Stops become market sells. Liquidity thins. The drop accelerates. Algorithmic amplification. Systematic strategies and liquidity-providing algos respond to volatility and order flow. Some withdraw liquidity. Others follow momentum. This can deepen the move, especially in a thinner market. Options hedging feedback loops. If there's large options positioning, dealers may hedge dynamically. As price falls, hedging flows can add incremental selling pressure, so what looks like panic is often just the system clearing leverage. This is also why margin hikes appear repeatedly in commodity history around sharp rallies. They tend to arrive when the exchange sees volatility risk increasing faster than collateral. It can happen at tops, but it can also happen during strong bull phases. In other words, a margin hike can coincide with a short-term peak in momentum without being a long-term bearish signal. A finance professional's way of summarizing part 1 is simple. Margin hikes are volatility controls. They pressure leveraged participants first. That pressure creates fast sell-offs, even if the fundamental story for silver hasn't changed by a single ounce. If you trade silver futures, you ignore margin dynamics at your own risk. If you invest in silver long-term, you should interpret margin hikes not as proof of fraud, but as evidence that the market had become over-levered and needed to reset. The biggest mistake investors make after a margin hike sell-off is assuming the move reflects new information about silver's real supply and demand. Often, it doesn't. It reflects forced positioning changes in the paper market. Two separate signal from noise. You have to understand the difference between a fundamentals-driven decline and a mechanics-driven liquidation event. A fundamentals-driven decline usually comes with a coherent narrative shift. Industrial demand collapses. A major recession reduces manufacturing. Mine supply unexpectedly surges, or monetary conditions tighten sharply and persistently. A liquidation decline is different. It's fast, often abrupt, and frequently occurs after a strong rally, when positioning is crowded and leverage is elevated. That's exactly the environment in which margin hikes tend to land. When the CME raises margins, it compresses time. Traders must act quickly. That urgency produces selling that does not care about long-term value. A fund doesn't sell because it believes silver is worth less over the next 5 years. It sells because its risk manager or clearing broker requires collateral today. This is why you often see violent down candles that look irrational. They are not valuation events. They are collateral events. Now add an important nuance. Silver's market structure is uniquely vulnerable to this kind of event because the futures market can represent a huge amount of paper silver relative. 2. Immediate deliverable supply. Even if most contracts are never delivered physically, the pricing reference is heavily influenced by futures flows. That means liquidation in futures can push spot prices down quickly, even if physical buyers are still active. So what should you look at to judge whether the sell-off is real? Professionals typically watch 4 categories. 1. Physical market premiums and retail availability. If futures prices dump, but premiums on coins and bars remain elevated, that suggests physical demand is resilient. Dealers aren't discounting physical inventory, and supply remains tight. That's not a perfect indicator, but it helps distinguish paper volatility from physical softness. 2. Delivery and inventory trends. If the sell-off coincides with stable or tightening inventory levels, it suggests the decline is driven by leverage rather than supply gluts. Conversely, if inventories are rising consistently and delivery pressure is easing, that can indicate a broader cooling in demand. 3. Open interest and positioning behavior. A margin hike sell-off often reduces open interest as traders exit positions. That's a classic deleveraging signature. A genuine trend reversal might show different behavior, new shorts building aggressively over time, not just longs being forced out. For macro context, real rates, dollar dynamics, liquidity. Silver is sensitive to liquidity conditions. If the broader macro environment is tightening sharply, a margin event can be the spark that triggers a larger downside. But if liquidity remains supportive and the sell-off is isolated, the odds favor a reset rather than a regime change. Now let's talk about why these events feel like it struck again. Margin hikes have a psychological pattern. Sees silver rise, then margins go up, then silver falls. It looks coordinated, but in many cases, it's simply the predictable interaction of volatility and leverage. The CME responds to volatility because volatility is the exchange's existential risk. Silver responds because silver is the market with the most leverage to unwind. This is also why the Selloff often feels oversized relative to the news. There is no new recession data, no mine shock, no sudden collapse in solar demand. Yet, price drops quickly. That's the signature of mechanical pressure. A practical way to think about it. Silver futures can behave like a crowded theater. When someone yells fire, everyone rushes to the exit at once. The exit is liquidity. When liquidity thins, price moves violently. Margin hikes force some participants to leave the theater immediately. It doesn't mean the show is bad. It means the room was too packed with leverage. For investors, this creates both danger and opportunity. The danger is emotional selling, assuming the drop invalidates the long-term case. The opportunity is recognizing that leverage flushes can create better entries if fundamentals remain intact. But you have to be honest. Silver is not for people who want smooth charts. Silver is a volatility asset. It routinely experiences sharp drawdowns, even in bull phases. Professionals accept this and size positions accordingly. Retail investors often don't, and they get shaken out. So part 2's core lesson is this. A margin hike sell-off is often the market deleting fragile leverage. It may temporarily distort the signal, but it doesn't automatically rewrite the fundamental story. Your job is to evaluate which one you're seeing, mechanics or fundamentals, evidence, not outrage. The final piece is the most important. What should you do with this information, and what does Acme margin hike actually signal going forward? First, let's separate traders from investors. If you trade futures with leverage, a margin hike is not a suggestion, it's an immediate change in your capital requirements. You must treat it like an earnings shock in an individual stock. It can change positioning fast, and it can trigger forced exits. Professionals manage this by controlling leverage, keeping excess collateral, and anticipating volatility regimes. They don't max out their margin during a runaway rally and then act surprised when requirements rise. If you're a long-term silver investor, you care less about margin mechanics directly and more about what they imply the paper market had become too leveraged relative to volatility. That leverage had to be reduced. This often creates price air pockets, but it can also reduce future downside risk once the flush is complete. Here's how professionals think about the after-period. Point 1. Leverage flushes often reset trend conditions. After a margin event, open interest commonly declines, speculative longs get washed out, and the market can rebuild from a cleaner base. That does not guarantee an immediate rally, but it often reduces the fragility that existed at the top of the move. Point 2. Watch whether physical signals diverge from paper price. If the futures price falls, but physical premiums stay firm, and inventory remains tight, that divergence suggests the sell-off is mostly paper-driven. If premiums collapse too, that suggests broader demand weakness. 3. Watch the quality of the bounce. A professional doesn't just look for green candles. They look for how price behaves around key levels after liquidation. Does selling pressure fade quickly? Does volume stabilize? Do buyers step in gradually rather than as a one-day spike? Does the market form higher lows over time? A weak bounce with persistent heavy selling can indicate a deeper macro shift. A stabilizing bounce after a flush often indicates the market is digesting leverage, not collapsing. For assess the macro backdrop, honestly, silver sits at the intersection of monetary factors and industrial demand. If real rates are rising sharply and liquidity is tightening, silver can struggle even without margin issues. But if liquidity is supportive and inflation expectations remain elevated, silver's longer-term case can remain intact even through violent corrections. Now, the phrase "it struck again" is emotionally compelling because it suggests a repeating event. Silver rallies, margins rise, silver dumps. But the more precise framing is, silver's leverage structure creates repeated vulnerability during volatility surges. Until that structure changes, these events will recur. Does that mean manipulation? Not necessarily. It means the market is structurally leveraged. That said, it is fair to discuss incentives. Exchanges want stable clearing. Clearing members want reduced risk. Large participants want predictable liquidity. When volatility explodes, the system prioritizes survival over smooth price discovery. That survival mechanism can feel unfair to retail traders, because retail traders usually carry the most fragile leverage. So what's the actionable takeaway? If you trade, keep leverage lower than you think you need. Hold excess collateral, so you're not forced out. Expect margin hikes and fast rallies and size accordingly. Use volatility-based position sizing rather than conviction-based sizing. If you invest, decide whether you are investing in silver as a theme or silver as a price chart. If it's a theme hedge, diversification, long-term thesis, then short-term liquidation events are noiseless. Physical signals break too. If you can't emotionally tolerate sharp drawdowns, reduce position size before the market does. It for you? Finally, what should you watch next after a margin hike sell-off? Open interest. Is leverage still leaving, or are shorts building aggressively? Volatility. Does it cool or stay elevated? Persistent volatility can mean continued instability. Physical premiums, inventory. Do they remain firm or weaken? Macro signals. Real rates. Dollar strength. Liquidity conditions. Market structure. Does silver begin forming a base, or does it continue breaking support levels with ease? A margin hike is not a prophecy. It's a stress response. It tells you the exchange saw volatility risk is high enough to demand more collateral. That's it. The sell-off that follows is often leverage being forced to behave. Few understand that. You stop treating these moves as mysteries. You treat them as part of the game. And in silver, understanding the game is the difference between being shaken out repeatedly or staying positioned through the cycle.